I think everyone has noticed that interest rates have risen pretty quickly over the last year and a half. The Fed rate keeps rising. They're going to meet again in the third week of March. The original speculation was that they would raise it about a quarter point. But recently the Fed came out and claimed they were a little disappointed that the mortgage rates actually slid backwards a little bit and did not run in line with the Fed raising rate. So mortgage rates don't have to exactly follow the Fed interest rate. That's the borrowing rate for the banks. If they can't sell a mortgage, if they can't get anyone to buy that mortgage, like anything, the prices have to fall. And that's exactly what happened with mortgages. So they got up in the high sixes, some places crossed 7, and they went back down 1/2 to 3/4 of a point for a little while. And then the mortgages started to run forward again. More people got mortgages. That's exactly what the Fed said they do not want. They're trying to slow the economy. So they then raise the interest rate to slow that economy. Well, since the mortgage companies backed off a little, they now plan to raise it up to 1/2 point coming up, with the idea that it's going to force the mortgage industry to follow along. They're going to have to raise their rates. If they do, you'll see mortgage rates cross the 7% mark. So let's just say we're using 7.25% for a mortgage rate. 18 months ago, you could get that same exact loan for 3%. So let's say you're borrowing $500,000 just for an even across the board number. $500,000. If you had a $500,000 note 18 months ago at 3%, you would have paid about $2,100 a month for just your mortgage, not including property tax and association fees and insurance and all that, just your mortgage. Today, if we hit 7.25, which it looks like we're going to, that exact same $500,000 is going to cost you $3,400 a month. That's a $1,300 a month difference in the exact same house just in 18 months. Over the course of the life of the loan, 30 years, you're going to pay an extra $500,000 to pay that note off. So the original note of $500,000 at 3% would have cost you around $775,000 over the course of 30 years. So the interest was actually lower than the principal. Now at 7.25%, that entire note at the end of 30 years will cost you about $1.25 million roughly to pay off. An additional $500,000 over the course of that note. And the interest is actually more than the original principal. That's what people are going to deal with now. Well, what it does is prices a lot of people out of the market. Even the people willing to pay the 7.25% will not be able to, because they now have to come up with and prove they can afford an extra $1,300 a month to have that same exact home investment. And a lot of people will be priced out of that market. Now, of course, the speculation on this is that home prices will fall. And they should. They need to. You know, when you don't have anything moving, then prices need to fall. The price determines the sale. But we have a weird situation here. So someone who maybe they're getting, in their mind, upside down a little bit on their mortgage, or they're thinking, I just want to sell and buy this other one. Whatever the situation might be, if they have a 3% mortgage, they're kind of stuck. Like, why would they sell that property and then go lock into a 7.25% mortgage? So if enough people decide to sell and the prices start to move down a little bit because of inaffordability, you're stuck in the middle. Like, I wouldn't sell. If I have a 3% mortgage on a $300,000, $400,000, $500,000, $600,000 house, why would I sell that to go buy another house where I have more than double the interest rate higher? It doesn't make sense. It's going to be a really interesting 6 months. I think even with that in mind, the prices still need to come down. I think they're still going to fall. Here in Las Vegas, probably more than other places, Las Vegas, Los Angeles, San Francisco, Miami, some of those places that rise and fall quickly, places in Arizona, Phoenix, I think we're going to see a bigger fall than in, say, Kansas City, Missouri, or something like that, because we've risen much higher over the years than they have as a percentage. So I think we're due for another, in my mind, 10 to 20% reduction in price. That's what I'm kind of banking on. That's what I'm waiting to see. And even with those higher interest rates, I think that's still going to come, even with people wanting to hold on to their homes. You've got some situations right now where home builders are contacting hedge funds because they can't sell all their homes off, and they're talking about selling the whole lot to a hedge fund. And the hedge fund will just run it as they see fit. Maybe they sell it, maybe they rent it. But now that property, it's kind of an interesting thing, would be completely owned. 100 home tract or 200 home tract or whatever it is, completely owned by a hedge fund that uses this as a hedge. They're now the ones owning the properties instead of individual homeowners. It's kind of a different dynamic, but as interest rates rise like this, people are looking for different opportunities and a way to hedge from the downside also. It's going to be interesting. If you like this content, like and subscribe for me and leave some comments for me. I'd like to see your feedback, see what you think is going to happen.